This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Happy New Year, everyone, and welcome to this special holiday edition of Nightly Business Report. I'm Tyler Matheson. Well, 2016 is here, and with a new year comes new resolutions. So while we can't help you cut the fat from your diet, we can help you firm up your portfolio. So tonight we will focus on the year ahead. Our reporters will highlight the things to watch in some of the most important areas of the economy and business. And we begin, naturally enough, with the stock market. While it didn't roar ahead in 2015, no way, it did see some big swings. Volatility returned, and some investors questioned the strength of this bull market. Part of the reason for the volatility had to do with the persistent decline in energy prices. Bob Pisani tells us what's in store for stocks in 2016, and Jackie DeAngelis examines the forces that will be at play in the energy market.
When making predictions, be bold and play against the consensus. So here are three predictions for 2016. First, the profit recession will finally end, but just barely. After 4 consecutive quarters of negative earnings growth, the S&P 500 will see earnings improve in the mid-single digits. The key will be a modest turnaround in earnings for energy companies after a 60% plunge in 2015. Second, after years of playing growth and momentum names like Apple, for example, investors will gravitate towards boring old value stocks, particularly energy names like ExxonMobil and financials like Citigroup and industrials like United Technologies. Finally, the proposed merger between Dow Chemical and DuPont won't be the last in the beaten-up materials space. There will be more in 2016. Fertilizer giant Potash tried and failed in a bid this year for German fertilizer giant K+S. But management said consolidation was still on the board, so companies like Potash will be talking to Mosaic, BASF, as well as K+S, as well as those in the seed business, including Syngenta, as well as Monsanto.
Oil prices saw massive volatility in 2015, hitting lows not seen since the financial crisis. Global producers continue to pump more crude, choosing to maintain market share despite a low-price environment. Here are three predictions in energy for 2016. Prices will bottom in the first half of the year. The biggest global oil producers, OPEC, Russia, and the United States, have not and will not significantly drop production in the first half of the year. This will cause crude to bounce around the $30 range, maybe even the 20s, before profit pressures force more meaningful production cuts that will eventually stabilize prices. Iranian oil will come online. Though the markets have already priced in this expected bump in reserves, when it actually happens, it could cause more pricing pressure initially until global supply is curtailed by other producers. Buy big oil. Share prices of big oil companies have suffered this year as crude prices dropped. They could see more pain in 2016, but names like Exxon and Chevron that pay dividends and are diversified will weather the storm and see upside when prices stabilize.
Joe Tanius joins us now to discuss his outlook for the markets in 2016. He's investment strategist at Bessemer Trust. Joe, Happy New Year to you. Let's start with the question of volatility, which Bob Pisani just highlighted. It was back last year, 2015. Do you expect it will remain or maybe even intensify this year?
Unfortunately, Tyler, I do believe that volatility is here to stay with us. Remember, we now have a Federal Reserve tightening monetary policy for the first time in nearly a decade. And while Chairwoman Yellen was very clear that this is going to be very gradual, there are no rush to prematurely raise interest rates too quickly, we are dealing with something that we haven't seen in a while.
We spent most of 2015 wondering whether and when the Fed would raise interest rates. Are we destined to do that again this year? And if so, how many rate hikes do you expect?
I think that's really the million-dollar question, right? This whole year we've been anticipating. I mean, this was the most highly anticipated rate hike in history, and now that it's finally here, of course, the next question is, well, when's that second rate hike going to come? They've been very clear, the Fed that is, in that this is all data dependent. But, to the extent that the labor market continues to heal the way that it's been healing, to the extent that inflation and inflation expectations continue to firm, I wouldn't be surprised if we see another 2 to 4 rate hikes in 2016.
Can stocks go up if oil doesn't and interest rates do?
I think stocks can go up, but the key here is to really temper expectations. Right? I think gone are the days of double-digit earnings growth that we saw a few years ago. just considering where we are in the business cycle, it's far more mature. We need to just temper our expectations. Having said that, we did touch on the dollar and we touched on oil prices. And while both of those appear to be stabilizing, it should bode well, I think, for earnings for the S&P 500 in 2016. We are coming out of an earnings recession, and I think that is certainly a support for risk assets and equity markets.
You say that your biggest overweight is U.S. equities. You have particular attention to discretionary technology and U.S. financials. Those are broad categories, particularly with respect to financials and technology. What kinds of companies are you talking about there? In other words, I'm not asking you to name names per se, but narrow it in a little for me.
Sure. I think we want to focus on companies that stand to benefit from a healthy consumer, right? Even just looking back at this last revision that we got from third quarter GDP, it was very clear the bright spot there is the consumer. The lower oil prices clearly having a negative impact on manufacturing, having a negative impact on energy, a strengthening dollar having a negative impact on our exports overseas. But the consumer has really been the bright spot. We have consumption numbers which continue to look good. We have sentiment and consumer confidence numbers which continue to thrive. We talked about the labor market. I think we're going to see wage growth finally picking up. We want to be exposed to companies that stand to benefit from that. So I think of consumer discretionary. I think of technology, but specifically the tech areas that stand to benefit from a consumer. And of course, with rising interest rates, U.S. financials.
Joe, thank you very much. Happy New Year. Joe Tanius with Bessemer
Happy New Year to you
Trust.
too.
You bet.
Thank you.
To the economy now, which got a vote of confidence from the Federal Reserve late in 2015 when it voted unanimously to hike interest rates for the first time in nearly a decade. But the outlook for 2016 is anything but certain. Steve Leisman tells us what investors need to watch.
The big question for 2016, how many times will the Federal Reserve hike interest rates? That depends on inflation, jobs, and the economy. Inflation should continue to fall towards the beginning of 2016 and then stabilize, assuming oil finds a bottom and the dollar doesn't surge. Inflation would then move slowly higher as the year progresses. Employment growth will downshift to a more sustainable level of between 125,000 and 175,000 jobs per month, more in line with labor force growth overall. Economic growth could shift slightly upwards, more towards 2.5% than 2% on average, but not burning up any chart books. All of that suggests a Fed that raises 3 times in 2016, depending, of course, on the data. But my big call for 2016, a change in how the stock market reacts to the decline in oil prices. The stock market finally comes to realize that low oil prices are good for the U.S. economy and rallies when prices fall, rather than the other way around.
Our next guest is upbeat on the U.S. economy, sees solid growth for the year ahead. He's Nariman Bharadwaj, chief economist at IHS. Happy New Year, Nariman. I'm going to do something I haven't usually done. I'm going to play word association with you. I'm just going to say some words, and then you give me what comes to the top of mind. Let's start with this phrase, U.S. growth.
2.5% to 3%. Again, solid.
Solid. Let's talk about Europe.
Okay.
How about China?
Decelerating.
Decelerating. How about the dollar?
Up.
Up. How about U.S. stocks?
Sideways.
Inflation in the U.S.
Edging up. That was 2 words, I guess.
That's okay. You're really playing along with me, man. I'm loving this. We could quit right here, and we've delivered the goods. All right, let's stop playing this and go a little deeper on some of the things that you think. I was very interested in what you said about China decelerating by how much and with what effect, most especially maybe on commodities.
Yeah. I mean, Chinese growth this year will probably come in about 6.9%. Next year, we think we're in the low 6s, 6.3, 6.2, something like that. And I think that'll be a further drag on commodity prices. We really don't see any surge in commodity prices in 2016. They'll kind of bottom out, but no big rise until China's growth stabilizes. And we don't see that, certainly not in 2016.
And in Europe, I've forgotten what you said, but you must make distinctions between some parts of Europe and other parts of Europe, most especially those parts maybe that have gone through austerity or are now facing a wave of immigrants.
Yeah. I mean, typically, Northern Europe is doing well. Germany, certainly. The Nordic countries are doing well. Sweden, for example, which, of course, isn't part of the Eurozone. UK doing nicely. And Spain, an austerity country, actually has done quite nicely in the last year or so. But Italy is struggling. Certainly Greece is struggling, Portugal. And so there definitely are countries that are not in great shape. On average, we're going to be looking at next year at just under 2% growth, maybe 1.7, 1.8.
Nariman, you're always a good sport. Happy New Year.
You too.
Nariman Baravesh with IHS. Well, financials and technology are two of the most influential sectors of the market. Joe Tanius just mentioned them. That's because they're the two most heavily weighted groups in the S&P 500. Kayla Tausche takes a look now at the financial sector in the new year, but we start with Josh Lipton and technology.
First, Tim Cook is proven right. Apple stock has gone basically nowhere this year as analysts have become increasingly skeptical about future iPhone sales growth. Prediction? Apple will surprise the street and grow iPhone units, boosted by a powerful upgrade cycle and lots of new fans in China. Second, Alphabet keeps marching higher. The company formerly known as Google skyrocketed this year, and in 2016, those gains will continue. In January, Alphabet breaks out the performance of its core business, giving investors a better idea of how search, maps, and ads are performing. And the bulls are right. Investors will like what they see and pile in. Third, Yahoo gets sold. Yahoo has suspended the spin of its stake in Chinese e-commerce company Alibaba, instead focusing on a spin of Yahoo Core and Yahoo Japan. In 2016, Yahoo will sell its core internet assets, which still attract a lot of eyeballs. Analysts say that core business could fetch as much as $8 billion.
Banks have watched innovation change their products dramatically. In 2016, they'll up the ante to make sure their longtime customers and investors don't flee to competitors. Here are some predictions. Shareholders will see more capital returned. The Fed's kept a lid on banks' buybacks and dividends after the financial crisis, but they're getting a better handle on the so-called stress tests and lobbying the Fed for adjustments that would let them give more back to investors. As earnings improve, look for payout ratios to rise too. Banks will stop trying to build their own products and instead will start buying other companies. Northwestern Mutual bought LearnVest to gain a foothold in millennial investing. JP Morgan partnering with OnDeck for alternative lending. And as Wall Street realizes its products are out of vogue, expect Lending Club, Square, and even PayPal to be in play. Blockchain, the code that made Bitcoin possible, is going mainstream. The number of companies exploring payments that bypass both consumer and central banks is growing exponentially and becoming more than just a fascination. By the end of next year, blockchain could become a major way to pay bills or settle trades.
Well, when it comes to transports, 2015 was a tale of two markets. Auto sales were strong while the overall transportation sector, planes, trains, big rigs, had a much more difficult year. But as Phil LeBeau and Morgan Brennan report, that could set the stage for a very interesting 2016.
In 2016, we'll see more cars and trucks with semi-autonomous technology, where the driver will be able to take their hands off the steering wheel and allow the car to handle things like acceleration, steering, braking, even parking. Tesla's Autopilot already has some of that technology, but in 2016, we'll see more models from BMW, General Motors, and other automakers. Next year will be a challenging one for electric vehicles, hybrids, and plug-in electric hybrid models. Why? Many believe the national price for a gallon of gas in 2016 will stay under $3. That means it'll be tough for new, greener models like the Chevy Bolt to gain much traction, even when they're being sold at a lower price point. Finally, expect the auto industry to have another record year for annual sales here in the U.S. Now, 2015 turned out to be much stronger than even the most bullish analysts predicted, and that momentum is carrying into 2016. Most dealers should do better, thanks to strong consumer confidence, low interest rates, and the fact that the average car or truck in the U.S. is still over 10 years old.
In 2015, transports got derailed by a strengthening dollar, plunging commodity prices, and slowing economic growth. Buckle your seatbelts because 2016 could deliver more of the same. First, the railroad rut will continue. Weak volumes will persist at least until the first half of 2016 as the commodity collapse continues to dampen demand and cheap diesel makes trucks more cost competitive. Railroads will have to curb CapEx after a record year of spending, and consolidation buzz will persist as the industry seeks new ways to grow. Second, networks will get smarter. Automation will creep into trucks as electronic devices that log location and driving hours get installed to meet regulations. Railroads will keep implementing a mandated automatic braking system, and drones will have more uses, not just for testing deliveries, but for inspecting tracks, bridges, and machinery as well. Third, package deliveries will get pricier. Both UPS and FedEx are raising rates as they do every year, but it's the U.S. Postal Service that could create the biggest bills. If regulators approve hefty hikes, that will up costs for Amazon and other shippers dramatically, which in turn could curb all those free shipping perks for the consumer.
Still ahead, plan on ringing in the new year with a new home? If so, there are things you'll want to pay attention to. Low gas prices and an improving job market put more cash in the pockets of Americans, but that didn't translate into a record year for retailers. In fact, it was a tough one. And as Courtney Reagan reports, the new year will bring a new set of challenges as well.
If retailers think the unusually warm winter is problematic, watch out for spring. Weather experts predict as El Nino turns into La Nina, the warm winter will morph into a cold spring, leaving apparel retailers' inventories again mismatched to the forecast. Bad for margins, good for deal-seeking shoppers. Some retailers have already taken the plunge and raised wages for hourly employees. It's only a matter of time before competitors will have to follow suit. And while some argue it helps retail by putting more money into Americans' pockets, it's a big expense for retailers, bites into earnings, and adds downward pressure to share prices. Even though retail stock valuations have contracted this year, the sector has been largely left out of the record year for global M&A, leaving consolidation a strong possibility in 2016. Cowen & Company calls out Hanesbrands, Signet Jewelers, Hudson's Bay Company, and Hanes Celestial as top picks for value-creating M&A next year.
Buying a home is the biggest purchase many Americans make, and there could be some big changes in store for the housing market over the next 12 months. Diana Olick has the real estate roadmap.
The housing market is coming off a good year, but facing increasing challenges which could derail the gains. Mortgage rates will rise, thanks to the Fed and an improving economy. Rising rates will hit first-time home buyers hardest, not just on the monthly payment, but on qualifying for the loan. This group has been lagging the recovery, struggling to pay the rent, which makes saving for that necessary down payment even harder. Speaking of rent, it won't let up. Demand for rental housing is high and will only grow. Developers have been churning out chic urban buildings, but the new supply still isn't enough to cut into record high rents. A new play for 2016 may be more builders looking to the burbs, where a lot more millennials are now heading. Don't bet on a big surge in single-family home building. Housing starts did rise this year, but not by much. They're still well below historical norms and even more below demand. Builders are cautious and struggling to get land, labor, and capital to produce more. Supply's already tight for new and existing homes now and will likely tighten even more in 2016.
Well, as Diana just pointed out, housing was one of the bright spots in the U.S. economy last year, so will it continue to shine in the year ahead? Anika Khan joins us now. She's senior economist at Wells Fargo Securities. Ms. Khan, welcome. Good to have you with us. Let's talk about housing and what you expect in 2016 in terms of which areas will be the hottest ones. It basically has been central business districts, inner cities, and the close-in suburbs. Is anything going to change that in 2016?
You know, that's a good question. If you look at underlying economic fundamentals, we're getting labor market conditions improving, wage and salary growth are gradually increasing, and we're getting a slight increase in household formations for owner-occupied housing. That should translate into better sales activity for 2016. Now, we also are seeing that where employment and population gains are increasing, we're seeing the fastest price increases. We also are seeing that central business districts, of course, are also seeing gains as well.
People want to live either in the city. I think of my hometown, Washington, D.C. There's just a growth, a spurt of apartment building and young people living close in Arlington or Bethesda. How about apartment rents? Are they going to keep going up the way they have been?
You know, apartment rents are at peak levels, especially in those markets where we're seeing a large portion of millennials. And we should continue to see that millennials will continue to drift into the central business districts. We talked about household formations. The largest share of household formations is still that renter owner occupied. And there's a large pipeline of pent-up demand from young adults still living at home. Those particular young adults that are aged 25 to 34 represent 14% of the overall population for 25 to 34-year-olds.
Ms. Khan, what are rising interest rates going to do to the housing market and to refinancing?
Yeah, there's a lot of consternation around the mortgage rate, especially with the Fed moving off of its lower bound. When we look at what should happen to the mortgage rate, we expect to see just a gradual increase in the rate. We, of course, are looking for a flatter yield curve, which means that on the lower end, we'll see a faster pace of increase. And on the long end, the 10-year, which is the benchmark for mortgage rates, will likely see a much more shallow increase. By the end of 2017, we expect to see mortgage rates somewhere around 4.5%, which is well below the long-term level.
Certainly is. Anika, Happy New Year, and tell all those people who are gathered behind you they can take the rest of the year off, okay? Anika Khan.
Yeah, absolutely, I will.
All right, with Wells Fargo Securities. Coming up, from politics to the price of drugs, what the new year has in store for some very high-profile issues on the campaign trail. Presidential politics was a big story in the second half of 2015, and guess what? It will only intensify in this new year. John Harwood takes a look at what to expect while Meg Terrell and Jane Wells examine two big issues on the campaign trail: drug prices and defense spending.
Few of us who cover national politics can say we haven't been surprised by the 2015 phase of the 2016 presidential campaign. When Socialist Senator Bernie Sanders entered the Democratic nomination race, who expected him to be leading former Secretary of State and First Lady Hillary Rodham Clinton in New Hampshire by the end of the year? When blustery billionaire Donald Trump entered the Republican race, who expected him to be dominating the Republican field pretty much everywhere? When all the candidates began laying out their plans for spurring economic growth, who expected that national security would be the dominant issue on the eve of the Iowa caucuses? So with lots of humility, here are three predictions about 2016. Whether she wins or loses in New Hampshire, Hillary Clinton will be the Democratic nominee. Bernie Sanders is going to have a tough time finding places to challenge her beyond New Hampshire. Donald Trump will not be the Republican nominee. Once we get past the first couple of states and the field consolidates, that's when Donald Trump will be vulnerable. And the American economy, middle-class wages, not national security, will be the focus of the 2016 campaign by the time we get to Election Day.
2015 for the drug industry started off strong, continuing an almost euphoric multi-year rally. But the second half wasn't as pretty. And in September, the tweet heard round the world. A campaign promise from Hillary Clinton ignited investor fears about pressure on drug prices. Here's what to expect for 2016. From candidate stump speeches to congressional committee hearings, the pressure on drug prices will continue. Democratic presidential candidates have suggested measures like enabling Medicare to negotiate on drug prices. But analysts doubt any real legislative change would come next year. And drug pricing grabbed international headlines after the 5,000% price increase on decades-old medicine Daraprim by Turing Pharmaceuticals. And drug giant Valeant came into the crosshairs for similar moves. In 2016, expect the rest of the drug industry to try to distance itself from this practice, and for political scrutiny of price hikes like these to heighten. Despite all the negative attention, branded drug prices overall are expected to continue to rise, according to a survey from Cowen Research. So insurers and pharmacy benefits managers will increasingly pit competing drugs against each other to win discounts from manufacturers.
2016 looks like more war, less peace. Terrorists are striking closer to home. Russia is in Syria. China is building up in the South China Sea. And we have an election. Here are 3 predictions. First, nukes rule. The Pentagon has less money than it planned for, so it will focus funding on the so-called nuclear triad, upgrading Ohio-class submarines, funding new missile designs, and the expensive new bomber, a contract won by Northrop, but which Boeing and Lockheed protested. Second, minimal mergers. The Pentagon is frowning on large mergers in the defense industry because it decreases competition. But companies have so much cash and can only do so many buybacks. Expect smaller acquisitions to pick up companies specializing in cybersecurity, surveillance, and drones. Third, rocket men. Elon Musk's SpaceX is recovering from a rocket explosion and will bid for its first military launch next year. But look out below. Amazon's Jeff Bezos will be the tortoise to Musk's hare. Bezos' Blue Origin space company will take the spotlight with progress on reusable rockets and a revolutionary new and powerful rocket engine fueled by liquid natural gas and liquid oxygen. No one has ever done that.
Wow. Thanks for watching this special holiday edition of Nightly Business Report. I'm Tyler Mathisen. For Sue Herrera, have a happy new year, and we will see you Monday.